Hello, everybody, and welcome to this week's edition of our weekly coaching webinar. Really glad everybody could join us. So today we're going to be talking about, I don't know, I guess you could say really the pitch. You could say the elevator pitch. You could say how to best summarize kind of what you do when it comes to offering business credit financing. So this has been something at Credit Suite we've worked on pretty aggressively over the last year, which is our messaging and getting our messaging clear. There's so many unique things that we do with a finance suite, with a funding team, that it's kind of been hard in the past to really summarize this in a way that it makes sense for business owners. So I wanted to kind of show you the clarity that we have been able to get with our messaging over the last year, and basically how we explain to customers, to prospective customers, to partners, to joint venture partners, exactly what it is we do. Now, I will make sure that this presentation that I have here is attached as a download to this video. So as soon as tomorrow you'll have access to this. I will tell you up front that this isn't the presentation we'll use in the future. Some of these money shots are things we just don't do anymore. It's against our brand guidelines. So we don't really offer these stacks of money and following money and some of these things. You'll have to disregard some of these images, but this isn't really designed for images. This is really designed just to give you an idea, a brief overview of how we really explain to prospective customers what we do. So this could be something you could use presentation-wise as well, but the purpose of this really isn't to physically give you this PowerPoint or to show you a PowerPoint. I'm just going to use the PowerPoint as a way of to show you kind of how we walk through this messaging. So some of this is our core messaging, some of this is a little bit expanded from that, and I'll show you that part when we get to it as well. So we've really found, and if you go to our website, creditsuite.com, you'll find that this is really our main headline now, that we help businesses get capital. And this is our main message. You know, when somebody asks us what we do, we kind of explain it that we help businesses get capital, and there's three ways that we ultimately do that. And here's those three ways. So this probably slide is the best reflection of exactly what our message is within 15 to 30 seconds to explain exactly what it is that we do. So we help businesses get capital, and there's three ways we do it. We do it by helping improve fundability, by building business credit for the EIN that's not linked to the personal social, and by accessing all loans and credit lines in one place. So that's really the easiest way that we summarize exactly what it is we do and how we do it. What we do, we help businesses get capital. How we do it is these three ways. So when you're explaining to customers, prospective customers, what you do, and they ask you, well, what is it that you do? You can just simply say, look, we help businesses get capital. We help businesses get money. You can exchange capital or money, one and the same. And then I like to go in and go, but there's a few ways we do that make us very unique. The first thing we do is we improve fundability. We basically are helping you build a fundable foundation so lenders want to give you money. And we're going to expand on all three of these. Then we help you build business credit for your EIN. And now we say this one of two ways now. We always used to say we build business credit for your EIN that's not linked to your personal SSN or personal social. Now what we say commonly that works really well with all of our ads is we build business credit for your EIN with no personal liability. So we also expand that way, whether you're saying build business credit for your EIN that's not linked to your social, or building business credit for your EIN without personal liability. Those are interchangeable. And the third is we help you access all loans and credit lines in one place. And I'll commonly expand on that we work with over 1,000 lenders to bring every legitimate funding program to one place to get you the most amount of money at the best terms. And again, I'm going to expand on these in the other slides, but that's the easiest way that I expand loans and credit lines. So when I look at these three, these are all very unique in themselves. I mean, first of all, I have a friend that actually doesn't help with fundability, but helps with the setup of businesses, some of the stuff that's in step one, and charges $3,000 just for that, just for the help with setting up the physical business. So when we look at really improving fundability, what we're basically doing is doing all the foundational steps that are designed to be able to help somebody become fundable. This is all the stuff that credit issuers and lenders use their algorithms and their computers to determine if somebody should be approved. Well, that's what fundability really is. It's going through all these factors and making sure that the business owner meets that criteria so they have the best chance of getting money. And then, of course, the business credit financing. So let's dive in and talk a little bit more about this. So why does fundability matter? Well, like we like to say, it really comes down to legitimacy. So when we talk about credibility or fundability, which we really don't use credibility as much, what we use now is fundability versus the word credibility, we talk about some of the factors that affect fundability. So getting the entity set up the right way. So an example here is that if somebody has a sole proprietorship, well, then they're much less likely to get financing in a lot of cases than an LLC or a corporation would be. As a matter of fact, a sole proprietorship has a 1 in 7% chance of getting audited, while a corporation has a 1 in 50% chance of getting audited. So the entity you set up can have serious tax ramifications, and it can also really result in less financing because you just look less legitimate. The same as not having an EIN. You don't have to have an EIN to have a business. You could be a sole proprietor and not even have an EIN. The business NAICS code. So I explain this now in a lot of presentations just like this. I say, look, the NAICS code or the SIC code is the code that the IRS uses to identify your business. It used to be a business SIC code, but then there needed to be more categories. So there was like 16 SIC code categories, and the IRS wanted to expand that to include more industries. So they created this NAICS code, which has more categories to categorize businesses. And I like to explain in presentations that, look, the NAICS code that you choose has serious ramifications when it comes to getting financing. And the worst part is you might not even choose it, meaning that your accountant might decide the NAICS code to put on your taxes, or even worse, the business credit reporting agencies could choose this for you, and then that could ultimately make the determination between approval and denial. So I use Credit Suite as an example. You can classify us multiple different ways, right? We could be financial services, we could be software. Well, we chose an NAICS code of software. We're a software as a service, we're a SaaS company. That's what we chose. Now, to make sure that that's stuck, we make sure that our taxes are filed with our proper NAICS code, and we make sure that any applications we fill out that ask for the NAICS code, we put the same code, and we also make sure that that's the same code the business reporting agencies have. Now, in more than one occasions, the business reporting agencies came in and attached a secondary NAICS code saying that we're in another industry as well. And we clarified them. We'll go back and dispute it and say, yeah, not the case. Nope, we're actually not. This is on our NAICS code. You have this wrong. And the bureaus have come back before and said, yeah, we think we have this right. We got it from third-party sources. And then we responded and said, no, you didn't. We know your third-party sources, and all the third-party sources have the information correct, including the IRS, including the other reporting agencies. Here's our taxes that show the NAICS. Here's the other reporting agency reports to show they got it wrong, right? You're the only one that's got it wrong. Why are you refusing to correct it? And sure enough, they immediately corrected it. So this is a big deal because when it comes to getting financing, an NAICS code itself can prevent you from getting financing if you choose the wrong one. So I like to explain this when I'm doing presentations now, and this makes a big impact, especially for very high level entrepreneurs. So I've been in rooms like my mastermind where every business is $1 million to $100 million business, and a lot of them are $10 million plus. These are very high level entrepreneurs. And what I like about this NAICS is that the minute I talk about this topic, they instantly lean forward. They're instantly interested. Many don't even know what the term NAICS code is. And then when I tell them, look, you're making it harder to get financing because you're letting the credit bureaus choose this for you and you haven't chose it, nobody in the room has chose their own NAICS code. So this speaks to very high level entrepreneurs very deeply, which is one of the reasons I use it. Your address, we've talked about this before, how, physical addresses, home addresses, virtual addresses matter, and how you should actually come in and have a physical business address first, a virtual address second, home address last resort, no PO box UPS address. Talk about the importance of phone and fax and getting it listed with 411 licensing, website, and email. This is all pretty basic stuff. But the other thing that we've now created, which you don't have access to yet, and you will, okay, don't even take a screenshot or anything like that of this because it's being modified. And trust me, the modified version is going to be way better than what you're going to see here, is this little financing factors graphic that we created. So we basically created a graphic here, and this is getting cleaned up and will be available to all of you. We're doing the same thing with funding and business credit as well. And this is performing very, very well at events and presentations, especially with high-level entrepreneurs, the kinds that you and I want to attract, $1 million, $5, $10 million plus businesses. And what I use this to explain is I say, look, there's over 125 factors that affect your fundability. Bottom line, there's over 125 factors that are plugged into computers that lenders and credit issuers use that they're using to determine if you're even worthy of getting financing. So a lot of the time, more than half the time that business loan applications are denied, it's not because you don't have the income or credit to qualify. It's because you don't meet basic fundability requirements that the lender and credit issuer has. You correct these, like getting your name to be the same as the Secretary of State on the application. That one small change can be the difference between getting approved and denied. So when I use this, and I use this graphic to overwhelm somebody, I say, look, these are some of the bigger categories: bureaus, dating agencies. And then what I'll do is I'll even zoom in. I'll say, look, let's just choose one thing here. Okay, so let's just look here and say that your debt to income ratio is just one of these factors that can affect your ability to get financing. Or what's in check systems? Do you know that you have a credit report with check systems and a credit score? Do you know that LexisNexis has all kinds of information about you you don't know they have? So that languaging too, the fact that there's information out there about you that you don't realize is out there that's being used to make lending decisions, creates a lot of fear in people. It's surprise. And then of course, everybody instantly wants to know what this is. So this has performed very well for us, which is why I'm going to make sure that you get access to this. I think I'm using backwards the wrong way. So you get access to this when it's complete. Because when we talk about fundability now, this is the graphic we use. Look, at Credit Suite, what we help you do is we help you get your fundability in line. What's fundability? They don't know. So I explain, look, there's over 125 factors you can see here that affect your ability to get financing. If even one of them is off, then it could mean the difference between an approval and denial. And even if you get approved, if even one of them is off, it can mean the difference between an 8 and a 15% interest rate. It can mean the difference between a 3-year term and a 10-year term. It can mean the difference between getting $75,000 and getting $300,000. So how comfortable are you that all of your fundability criteria is in line? Now, when I did this in front of my mastermind and I asked them for feedback, they said, one of the people that was in the audience said, look, at first I was completely overwhelmed by what you said, and then I took a big sigh of relief because I know I have you handle this for me. And that's exactly what we're trying to create. We're trying to overwhelm them with all this idea and these factors of what really affect qualification. And then we're trying to say, look, when you work with us, this is what we're doing. We're going through and making sure your business is set up where it's fundable so you have the actual best chance of getting financing. So this is really, really, really cool. And as a matter of fact, it's interesting because we've made a big shift as a company where we now talk more about fundability than we ever do about actually getting money. So many people come in the door to get money, and it's so easy for us to say, look, have you ever applied for a credit card or loan and got denied? Yeah, I have. Okay, well, then the reason is because you don't meet some of these fundability factors. And that's what we do here is we help make sure that your business is set up where it's fundable so you have the best chance of getting approved. If you try to run out and get loans, you're either going to get denied or get a fraction of what you could have got unless you complete this step. It's why it's the first thing that we help you do. So fundability, very important, and that's how we explain fundability, what it is, why it's important, how it actually works. So then we kind of expand out and talk a little bit more about why loans do get denied. We talk a little bit about congruency as well. So as a matter of fact, when I talk about congruency, this is something I talk about a lot now when I'm doing webinars, when I'm doing presentations, when I'm standing in front of large groups. Because believe it or not, over 50% of loan applications are denied. And I ask people this, do you know the number one reason that why applications are denied? And a lot of people say credit, a lot of people say income, and a lot of people will say a lot of things. And then what I answer with is no, it's actually fraud. Okay, so that's why loans get denied. They get denied because the information you're putting on the application isn't congruent with information that the lenders are getting elsewhere. So what they're doing is their computers are picking up this disinformation, this incongruency between what you're putting on the app and what they're finding at other sources, and that's immediately getting the application denied because of fraud, or throwing up red flags which push it for a manual review because the information is incongruent. And I use all kinds of examples, including one of my favorites, which is our clients, the samples, and they actually went in to get a $100,000 loan, got denied because they actually had a mismatch in their name from their Secretary of State records. And when we have corrected that one error, it meant the difference between them getting denied and getting approved for a $100,000 loan. That one error was the difference between denial and approval. So again, that's just one fundability factor. So this incongruency creates all kinds of problems. Then I explain something that very, very, very few people know about. This is the secret of the bank lending system that most people, it blows them away when they know about it. And again, it ties into why what we do is so important. Let me introduce you to something called the SBFE, the Small Business Financial Exchange, the thing that controls your fate when it comes to getting business loans that you don't even know exists. So the SBFE is a third data congregator. They congregate all kinds of third-party data from its members. Now its members are all banks. Well, you probably know some of its members: Wells Fargo, Bank of America, Chase, Regions, etc. The members are the ones that actually own this third-party data aggregator. And it's basically based on a give to get framework. So it means if you're Chase and you want to be part of SBFE, then you got to give to get. Meaning you have to give every bit of information you have about that customer to SBFE to get the information from all the other sources. So if I'm Chase and I want to be part of SBFE, which I am, then I have to give that person all of your information, everything you filled out on the application, how you've performed on your loan, all the information I have about you has to go to SBFE. Now, the benefit to me is I then get to tap into SBFE to get all the information that Bank of America knows about you, and all these other banks out there know about you as well. So by being a member, I'm getting all this information about you from the other banks. Now, is this surprising? Did you ever know that when you go to apply for a Bank of America credit card or loan that they're tapping into all the information that you've supplied Chase and Wells Fargo in the past? That's how the system works. And all the bank information is shared. So what's happening here is that basically SBFE gathers information. You apply for a Chase loan, bank loan, or let's say a business loan with Chase, and then Chase is pulling all the data from the SBFE and basically comparing your application to it. They're making sure that the information that you're entering on the application is congruent with other records they've accessed. Now, if they see different spellings of the name, different addresses, different revenue levels, all these different things, well, then the application obviously gets spit out for potential fraud because you're applying in one source with completely different or inconsistent information than there is another source. Now, the only place this information is available to you is from vendors. So that means the only information you're going to see from SBFE, and you'll never see all of it, you'll only see some of it, comes from vendors. Vendors are the only ones that have the ability to access that information and make it public. And vendors are people you know: Dun & Bradstreet, LexisNexis, Experian. So the reporting agencies also have access to SBFA. They take and congregate some of the data, and some of that data is what shows up on your credit reports. So when it comes to commercial credit reports, then some of the data you're seeing is coming from this SBFE database. And if you want to know where it comes from, it comes from these members, which are the big banks. Now, again, I'm explaining to you more depth than I explain it sometimes in front of people. But what I'm trying to show here is, look, there's this whole behind the scenes world you don't know exists. And because you're out in the dark and you don't know it exists, these guys, these members, these banks are making all kinds of lending decisions about you based on data you don't even know they have. Now, I got to tell you, the minute I start talking about this, especially to high-level entrepreneurs, they all lean forward, they all perk up. The idea and the concept of information being out there that they don't know exists, that lenders and credit issuers know exist, stems a lot of interest from them. So that's how SBFE works. But here's the other part of this, okay? LexisNexis is even worse than that, because if you think that some of this data comes from SBFE, LexisNexis is a whole other animal that most people don't even know exists. So as a matter of fact, if you have judgments on your personal credit report, they're probably coming from LexisNexis. If you want to get judgments removed from your personal credit report, you know what you do? You dispute them with LexisNexis. Then you dispute them with the credit bureau. So when the credit bureau pulls the data from LexisNexis and they're gone, then all of a sudden you don't have those issues that you once had. So this is something, again, that a lot of people don't even realize exists, is LexisNexis. And so I often stand in front of very large rooms and I say, how many people here have honestly ever looked at your LexisNexis credit report? And at best case scenario, I've only seen 1% of people raise their hands. I've stood in front of masterminds in front of 30 people that make $5 million in revenue or more, and not one of them has ever raised their hands. Now, then I get into what's on a LexisNexis credit report. I said, well, you should probably do that, because this is where insurance providers, law enforcement, lenders, credit issuers, suppliers, all these people are getting all this information from LexisNexis that you don't even know exists, and pretty much your entire life's history is on LexisNexis. And then I get into some of the things that are on LexisNexis. So for example, every address I've ever lived at is on LexisNexis. All the details of my home are on LexisNexis. By that I mean, you know who my homeowners association is, the square footage of my home, the type of air conditioning units that I have, how many garages I have in my home, the building materials that were used to build my home. All those, that level of detail are in LexisNexis, including every vehicle I've ever owned, every insurance policy I've ever had on those vehicles, as well as every email address, every job I've been ever associated with, every business I've ever owned, every license I've ever held, in my case, including my mortgage broker license and my pilot's license. Marriage licenses are there, divorce, the divorce history is there as well. Any criminal record that you've ever had, including misdemeanors, every traffic ticket you've ever had. Now, when I'm presenting in front of a group, I always make a joke here. I say, look, my LexisNexis is 300 pages, and given, 250 of that's probably my speeding tickets. But I make light of it, but really people are blown away that this level of detail. Now, at one time I did this, I actually brought my LexisNexis credit report, 300 plus pages, and I held it up and then I threw it down on the table where it made a massive thud. I said, have you ever seen your own credit reports? Okay, yep, everybody, here's what LexisNexis looks like. It's a book, and I throw it down on the table and it makes a huge thud. And then I go into all the things that are in there. Why does this matter? I give a personal example. When we applied for Credit Suite for an SBA loan, they actually came back with an approval wanting me to collateralize my home to get the loan. Well, that makes no sense, because Credit Suite has 7 figures in account receivables, which are more than enough equity to cover, or more than enough in assets to cover the loan. But the reason for this was because there were 2 judgments on my LexisNexis credit report that had them freaked out. Now, so this was not public information. They did not tell us that that was the reason they collateralized the home. We figured that out. Here's the worst part. The judgments were not even accurate. The judgments on LexisNexis were bogus. They weren't even true. Do you know how hard it is to prove a negative? Do you know how hard it is for me to prove that judgments I don't have? So I had to go to the courthouse. I had to pull all these records online going, look, here's my name in searches on the county. You can see these don't exist. Here's the information I got from the county. Here's everything. So I was able to supply enough to the underwriter to prove that the judgments were bogus, and they did remove the stipulation. And then guess what I did? I went to LexisNexis and I sent all the same information to them, and they removed the judgments as well. And let me tell you, the whole world opened up for us then. For having problems with merchant accounts, having problems with all these things that we had experienced in the past, the minute we started to clean up my personal LexisNexis credit report, it was like a 180. We never ran into problems again, from financing to credit cards to merchant accounts. Anything we'd ever run into resistance on and we thought was industry specific wasn't industry specific. They were pulling up stuff that had them spooked from LexisNexis credit report. Let me give you another example of why this is a problem. SBA loan. Have you ever been convicted of a misdemeanor? No. I'm pretty straight-laced. No. Well, then they came back and said, well, actually, you have been. You've been convicted of 2 misdemeanors in the past, and you need to explain now what these were and why you lied about them. Well, I don't even know. I had to literally pull a personal background check on myself to even go back enough in time for, 30 years to figure out what they were even talking about. And then I found out what they were talking about, which was, 19, 20-year-old kid stuff to do with motorcycles and all kinds of crazy military things. Okay. And sure enough, I wrote an explanation, said, as you can see, I've been straight-laced since, never had a problem before, and then go through the process of disputing the stuff and having it removed from LexisNexis. Okay, so there's two different cases where we almost didn't get a $325,000 loan specifically because of stuff that was on our LexisNexis credit report. When I stand in front of audiences, I use those as specific examples. And then I tell them, isn't it crazy that all of this information is out there about you that you don't even know exists? It's readily available to anybody that wants it, and they're making all kinds of serious decisions about you based on that information. This freaks people out. So again, next part of the real story for you guys, we approached LexisNexis and said, what the hell? This is messed up. Like, you can't give this stuff to lenders and not give it to people. Like, how do we get that data into people's hands? And luckily, LexisNexis said that's what we want to do. But nobody's taken on the task to take that data and bring it front facing. And we said, we will do it. So we signed an agreement with LexisNexis, and we are currently getting all of the data from them, and then we're putting it into a score format and a format where you and all of our clients are going to be able to see this probably within 12 months or less, see a fundability score, see where their information doesn't line up with LexisNexis, and start getting things fixed so we can fix the underlying source of where the data is coming from to give them the best chance of not only getting credit financing, but supplier accounts, to merchant accounts, to everything else in between. So again, when I talk about fundability quickly, briefly, I don't get into this level of detail, but I do mention that, hey, look, there are things like the Small Business Financial Exchange, which share all the data you've ever given to a lender with all other data, with all other lenders and banks. There are things like LexisNexis that track everything to do from every traffic ticket you've ever had to every misdemeanor you've ever had to every house you've ever lived in, email address, and in between. And I'll tell you, those are two fundability factors, not to mention everything else. But when, again, I'm standing in front of large groups, I will now present this, especially with high-level thinkers, so they understand what fundability is, and they understand that one issue with fundability can cause serious problems that will prevent you from getting the things that you want to get. Next thing, we come in and talk about business credit building. So when we're talking about business credit building, again, what we're doing is helping you build business credit for your EIN that's not linked to your social. Basically, this gets you away from personal liability. One of the easiest ways we like to explain this now is we say, look, do you want to continue to personally guarantee the things that's going on in your business? No, I don't. Well, if you ever want to get away from personal guarantees, it only happens by building your commercial credit profile. Commercial credit profiles are what help your business stand on its own, so then they don't need you to come in on the personal side of things, okay? That's what that's about. So this is exactly how I explain business credit now. And when we come in and we have people that say, I just want to get money, okay, well, if you only get money, then are you okay paying 20, 30% interest rates for the rest of your life, for the rest of your business life? No. Well, then you have to fix the underlying issues like fundability, like business credit, that are creating a scenario where it's harder for you to get the money you need. But one of the easiest ways we explain it is, do you want to continue to be personally liable for everything that's happening in your business? No, of course I don't. Well, then you have to understand the definition of a personal guarantee is that your business doesn't have the credit to stand on its own, so it relies on your credit to carry it instead. If you ever want to get away from a guarantee, you have to build the commercial credit profile so the business can stand on its own. It's the only way to get around guarantees. So business credit helps you get the credit, the financing, or helps you get away from the personal guarantee. It builds the commercial credit report, so the credit you get reports on your business credit reports, not your consumer, okay? And again, I'll explain what this does. Over 30% of your personal credit score is utilization. A third of it is utilization. So when you get personal credit cards that you use to fund your business and you put limits on those or balances on those that are too high, you damage your personal credit scores, and this continues to happen month after month after month. I can't tell you how many times I say that to people and they're nodding their hand wildly, and then they'll go, yeah, it happened to me. This is what I did. This is what I did. Everybody can relate to that because, I mean, look, I got my hand raised. Don't know about you, but almost everybody I've ever met uses a consumer credit card to do things for their business in the beginning. It's just the way that it is. So when you say that, it's very real to people. They can relate to that. obtain high limit accounts very quickly. I said, look, the purpose of business credit is to get very high limit accounts. As a matter of fact, per SBA, they're 10 to 100 times higher with commercial accounts than consumer. And you can get them fast because business credit scores are based on how you pay. So we just got to get you credit that reports to the reporting agencies. And we also talk and tie that back into fundability as well. Now, another benefit that, well, these are the main benefits that I'm really using. The fact that it is built quickly, the fact that you can get high limit, that you can get it without the personal guarantee, without the personal liability, that you're building the commercial credit profile and score. So these are just a brief summary of 4 or 5 different benefits that I really use to summarize why business credit's effective. Okay. And then I just come in and just talk about where they can access business credit reports, set up their DUNS number. Now, I typically come in and I'll go through it and explain it this way, which I can't use this third one because they no longer add utilities to Experian. But I'll come in and say, look, when you're building business credit, there's a couple ways to do it. You can get unsecured business financing up to 150 grand. This is where you're using your credit or that of a guarantor to get 0% no-dot credit lines. Those of you that are familiar with our funding programs, this is called UBF, unsecured business financing. Or you can get credit with some vendors. These are vendors that report that credit to the business credit reporting agencies. Now, just so you know, a lot of cases, I don't even explain this anymore. I won't even explain the actual steps to build business credit. This was done in front of my mastermind where I wanted to explain those steps, but in a lot of cases, I don't. And then I basically come in and just say, look, with 5 accounts, you can get store credit. And then you don't want to authorize a personal guarantee or credit check. Then you can get fleet credit, about 8 to 10 accounts reporting, and that's the that's vehicle financing. That's that's fuel cards. That has to do with getting fuel, repair, and maintenance of vehicles. And then with 10, you can also get cash credit, which we're changing that term cash credit because everybody thinks that cash credit are credit lines, and that's not what we're saying. What we're saying is at 10 or 14 accounts, you can get Visa cards, MasterCards, you can get that kind of credit. And I tell people the truth, this is very slim and hard to find. Sources come and go. At any given time, there may be 2, 3, 4, 5 of these credit accounts, and then they're gone, and then new ones come in. Okay, but at 10 to 14 accounts reporting, you get to that final tier, including auto financing, and that's when you want to keep applying for more credit. But again, a lot of case, I don't really get in and even show the steps of building business credit. I just basically give them a really brief overview. But this is for my select mastermind members, and they all have money. They're going to pay us for the service, whether they know the outline of the steps or not. A lot of other people will think because you outline the steps that they then know what they need to know to get approved. Now, this is exactly why we now bring the conversation back to fundability, because as we've monitored the conversation in our business credit group, which is excessive now, it's like 20,000 plus 25,000 people in it. But we created that group because we want to monitor what people are saying and what they're doing when they're trying to do this on their own. And what we find is that one person will come in and say, I got an Amazon account, net 55, $20,000 approval. The next guy goes in and gets denied and gets frustrated. And so what we're doing is coming back and saying fundability, 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 fundability. The reason he got denied and you got approved, or that he got approved, you got denied, is because you don't meet the basic fundability factors. One of your 125 fundability factors is off. That's why you're not getting approved. If you would fix fundability first, as we do for our clients, then build business credit, that's the path to success. So it kind of disarms this. It disarms the people that think that they're going to go out and do it on their own because they have a basic idea of the steps. Now, I don't have it here, but on my webinar presentations, I'll also pull up about 50 to 70 questions that people ask. I'll say, I know, I don't want to mislead you that this is easy, and then I'll start pulling up Facebook comments of questions people ask, another one, another one, another one, another. I start showing how everybody gets stuck in this process and talk about why having somebody that helps you, that knows what they're doing, is so crucial to getting the absolute best result. But again, coming in, brief overview of exactly how the system works. Now, I like to tell people as well, look, what we do is take 24 months to 36 months of business credit building and condense it to 6 to 12. That's ultimately what we do. What will take you 2 to 3 years to do on your own will take you less than a year to be able to do with us, sometimes as little as 6 months. So that's how I explain it, is instead of taking 2+ years to build business credit, you're doing it with us in 6 to 9 months. You're saving a bunch of time, and you're actually saving a bunch of money because you're going to pay $2,000 more for credit monitoring. You're going to pay for 411 access. You're going to pay for a business valuation to see how much your business is worth. You're going to pay for all the stuff that you're getting free with us. And by the way, I don't know if it's added yet, But to take a step back, we are accessing the ability to get LexisNexis and ChexSystems reports through our system as well. Let me clarify. They're not going to be able to get ChexSystems report through our system. We've got to work with ChexSystems to create a credit monitoring product, which we will in the year to come. Or excuse me, we have to work with LexisNexis to create the credit monitoring product, which we will in the years to come. But we will help them through the steps. We'll help them download the form and do what they need to do to order both of those report, LexisNexis, ChexSystems. So your customers will soon, if they don't already, have the ability to log in the system and actually follow steps to get both LexisNexis and ChexSystems. Okay, so that's going to help give us a huge selling advantage, because when you're pitching this stuff and talking about fundability and ChexSystems, and there's a score they don't know about, and talking about LexisNexis, you're then going to be able to say, hey, look, by the way, you're able to follow the steps in our business credit builder and be able to access those. Okay, so we comes to the final point, right? We talked about fundability, we've talked about business credit building, then we get into the point that we're helping you get money. And I talk a little bit about something you hear me say all the time, which is basically the 3C approval formula. In order to get any kind of money, you need cash flow, credit, or collateral. If you don't have any of those, you're not going to get a loan or credit line, but you could still get business credit. But even if you have some of these, you're still going to need fundability and business credit to get the most money at the best terms, things to keep in mind. So I explained that, look, when things changed in 2008 and this Dodd-Frank rolled out, then what happened is it made it very tough for lenders to lend money. And then all these alternative lenders, thousands and thousands and thousands of alternative lenders started to show up. And instead of looking at all of your business, you have to be perfect. Your business has to be perfect. Now all they care about is one of three things: your cash flow, your credit, or your collateral. Now, the nice thing about this formula is you only need one to get approved. And the nice thing is if you have more than one seed, then you get better financing and better terms. So that, if you only have cash flow and your credit sucks and your collateral's non-existent, then you could still get money. If your credit's good, but you have no cash flow or collateral because you're a startup, you could still get money. If you have collateral from you or a guarantor, but your credit sucks and you have no cash flow, you could still get money. All you need is one of these to get approved. But let's say you have two of these. Let's say you have pretty good cash flow and you have good credit. Well, then that opens up term loans. Let's say that you have all three of these. Well, then that opens up SBA loans. That is the way the approval formula works. I don't care what kind of loan or credit line you're applying for. It's how it works. Big banks, small banks. Okay, it comes down to your approvals based on one of these three things. The better financing terms, the more of the C's they're going to want to see. That's what it comes down to. Then I go into this. Here's the problem. The problem is that if you go to a bank like On Deck that you maybe have heard of on TV, well, if you have 850 credit scores and you have no revenue, they cannot approve you. They will not approve you because they are strictly based on your revenue. But if you go to their website will tell you nothing about the fact that their approval is based completely on your revenue. If you go to Seed Capital and you've got tons of revenue and your credit sucks, they cannot help you, because what they're doing is focusing on your credit only and nothing else. So if your credit is not good, they cannot help you no matter how good your revenue is. That is fundamentally the problem with the business landscape, is if you go to either of these companies' websites, their websites will not tell you what they're looking for. So if you go to On Deck and you apply with no revenue and get denied with an 850 credit score, well, then you're probably going to think that you have no hope of getting approved. But the reality is there's thousands of other lenders that absolutely would have lent you money in the same situation based on only your credit, that C, and not the cash flow C. So the problem with you, Mr. Entrepreneur, is you have to do two things. You have to happen to know with a magic ball the exact funding program you can qualify for, and then you have to know the exact source that's going to be the best fit for you. Because even if you have the cash flow, On Deck might not approve you because they don't like real estate agents. And guess what? This other lender might love real estate agents. So based on your time in business, based on your credit, based on your industry, you might be a better fit for lender A versus lender B. So now, Mr. Entrepreneur, you got two challenges. You got to know with a magic ball the exact funding program that you're going to be able to get approved for to know where to apply. Then with a magic ball, you have to choose from the thousands of lenders that offer that one program to figure out who exactly is the best source that's going to give you the most amount of money. Well, guess what? That's what we do for you. What we do is we work with over 1,000 lending sources. We work with every one of these programs and more, every legitimate funding program out there. So you don't need the magic ball to determine all the financing you can qualify for, nor do you even need to know the source. What we do is we come in, we do a funding blueprint to determine all the financing you can qualify for. And since we offer all legitimate funding in one place, notice I said legitimate because I don't want to say we offer all funding in one place. There's all kinds of shady or unproven funding products that are out there that we don't offer because they're not tested yet. But if we find a funding product like peer-to-peer lending, which is one of the newest on the scene, and we vet it and we test it and it's successful and lender and clients actually get money, well, then we start promoting it and offer it the same way. So again, the nice thing, Mr. Entrepreneur, is that we offer all funding in one place. You don't need a magic ball to determine your funding program. Our finance officers figure all that out for you. Then our finance officers won't only just find the best source that will give you the best money, but they'll find the best source in this moment in time for you. And what I mean by that, Mr. Entrepreneur, is guess what? Some lenders could be perfect for you last month, and then something weird happens. It's almost like their money tightens up this month, and they're just not approving anybody. We know at any given time who's the best source, who's the best program where you can go with that program and go with that source to actually get approved versus trying to manage this on your own. Now, if you're bringing people in for direct funding without selling business credit first, well, then it's very easy to do this because I explain to people, we don't even charge you fees for this. Like the lender will give us a referral fee in some cases for referring the financing, but we don't even charge any money on this. And on top of that, Mr. Customer, we're going to get you better financing terms with that lender because some of these lenders we're putting millions of dollars of business a month with. So who do you think they're going to give better terms to? You, the one-off person that goes to apply, or us, the person that's giving them over $1 million worth of business consistently? To keep our business, they give our customers better rates. We pass those rates on to you. So not only do we help you navigate this very difficult space, you're not even charged any extra money on the funding side to be able to do so. And so we explain financing. So you can see what we're doing here. It just goes with complete overwhelm. And that's what it really comes down to with fundability in this. Complete overwhelm. There's so much to choose from. Are you confident that you're really choosing the right thing? Nobody's confident, especially when you start teaching them about LexisNexis and check systems and all these things that they had, SBFE, all these things they had no clue even existed. When you start teaching them all these things, they immediately go, oh my gosh, there's all this stuff I don't even know. And then it just becomes this fear of them missing out. And guess what? You're the answer. You're the answer to the whole equation. You're the one that can then do all three of these in exactly the same place. Back to what we do. We help businesses get capital. And we do it because we help you establish the fundability. We help you go through and set up your business where it's fundable to make sure that the I's are dotted and the T's are crossed so you meet the criteria that lenders and credit issuers are looking for to know you have the best chance of getting approved before you apply. If you don't fix this, for the rest of your business life, you're going to suffer and either not get the money you need or you're going to get it at much worse terms than you would get it if you had your fundability in line. Here's the great news. Once we go through this one time, once your fundability is gone through and your business is set up where it's fundable once, you never need to do it again. But if you never do it, you're going to fight an uphill battle getting money. Again, 125 fundability factors. Mr. Customer, how comfortable are you that you're good in all of those? Nobody's going to be. Nobody's going to say yes, that they're comfortable there. Second, we're helping you build business credit for your EIN that's not linked to your social. This is the credit you're getting without the personal liability. This starts you down the path of eventually not having to use personal guarantees for everything that you're doing. You're able to immediately come in and start getting a high limit revolving credit cards without a personal guarantee, without a personal credit check, while building your business credit, which helps make you more fundable. This is the difference between getting 75 and 100, 325,000. This is the difference between an 8% rate and a 16% rate. As a matter of fact, your business credit reports even recommend how much money you should be given. And if you think that that recommendation's there, one of the first things that show on your credit report, and lenders and credit issuers aren't using it, you're naive. That doesn't exist. There's a reason that one of the first pieces of data that comes on a credit report is how much money the Bureau recommends you should be given, because that's what in large part controls the limits that you're approved for. So again, by building your business credit, you become more fundable and you're accessing those high limit accounts and getting away down the road from personal liability. And We also help you get all business financing that's legitimate in one place. And we graduate you to even better financing. Look, we're not here just to slam you into a loan you can get now and say sayonara. We're here to help you get a loan you can get now and then also graduate to the next loan, to the next credit line to get more and more financing. Our goal is to help you get SBA loans that are 10, 20 years long and 8% rates. That's where you can get all this extra money without having to pay a bunch of extra terms to get it. And I'm going to pull up, and I don't have it in this slide, but I've got a real Credit Suite example that I'm now using that I do have in another presentation that we're getting ready to test this week. And if this tests well for us, I will let you know. And then what I will do is I will then make the same presentation available for you, as we do with everything, guys. We test it to make sure that it flows and works okay as it should. And then what we do from there is then we'll release it to you to make sure that you have access to that as well. So I'm just trying to look here because I have a great slide that I use, and I don't even know if I'll be able to find it here or not. It's going to be dispensing. Actually might not be it. So just give me a second here. Let me find it. Okay, I think I found it here. Okay, so this is a new webinar that we are getting ready to test this evening. And let me see if I can find this new slide that we're now using, which is a comparison of two. Okay, so here it is. So these are real loan comparison. This is 100% legit with us really getting two different loans. And so I'm using this as I talk about fundability. And here's why I use this slide now, because I found that, and I'll give you an example. I was talking to Corey Bergeron, a buddy of mine, in my mastermind, amazing guy when it comes to video production. And so he said, dude, I feel so bad after hearing your presentation. I just went out and got a credit line and I didn't even think to call you first. And I said, that's cool. Congratulations on it. Tell me a little bit about it. And so he tells me, for example, that he got an American Express credit card from his bank. I said, Corey, to give you an example, I said, how much was your limit on that? And he told me it was like $15,000. I said, in our world, I would have got you 5 of those, not 1. In my world, I would have made sure all 5 report to the business credit reporting agencies. Where did yours report? I don't know. That's the problem. Most of these American Express, like you got, very well could report on the personal credit. So in my world, I'm getting stuff that only reports to your business credit, and I'm getting you 5 times as much. So the reason I'm telling you this is that there's this mentality out there that, hey, I got approved, so I don't need you. So what I do now is I use this slide to say, look, even if you can get approved without making sure your fundability is straight, you still might not get and probably won't get the type of loan you should. So here's a real example from Credit Suite. Before we got our fundability in line, we got a revenue financing loan. The loan amount was $70,000 for 36 months, and the rate was 10%, which, by the way, is phenomenal rate on this kind of loan, right? I mean, we know this. Most of these revenue lending loans are 30% or higher. We got the rate at 10%. About the lowest you're going to get with this kind of financing. And our payment was $9,600 a month with that loan. Now, we come to loan B, which is the most recent loan that we obtained once our fundability was in line. Once we fixed LexisNexis, once we did the things that made us more fundable, we got an SBA loan for $325,000. The term was 10 years. The rate was 8.25. The payment was $4,000. That's astonishing. And this is real. So we actually got a loan for payments half as much, and we got $250,000 in additional funding. So I show this example now because, look, I want people to understand maybe you can get money on your own. Maybe you can. Maybe without addressing fundability, you can come in and get financing on your own. The question is, if you would have had the fundability lined up, how much money are you overpaying in payment, and how much less money did you get because you didn't have the fundability set up correctly? Okay, and again, that's a pretty real scenario. This is very real in our world, but that's like a mind-blowing thing to a lot of people, because then even if they're like, I don't need this, I got approved for financing, then they start going, oh man. And this is exactly something that somebody came up to me after my presentation and said. They go, man, when you started off, I'm like, I know all this stuff. I'm good. I've got credit cards. I've got loans. But the minute as you got into this stuff, I started to realize that I'm completely screwed. And they use the word completely screwed. So I'm like, this is somebody that said, I don't need you. I already got money. To then going, oh my gosh, how much more am I paying in interest than I should be? How much higher are my payments than I should be? How much money could I have got if I would have done it the right way? So I really like this comparison now, because now a comparison shows A to B to show, hey, look, when you're actually coming in and doing the right things, you can get considerably better terms. Now, in the past, I've just said that. Look, fundability, this is the key to getting the most money at the best terms. But that sounds good, but it's not as real in the face as what something like this is, where somebody can realize in real time, wow, $250,000 more money at half the payment? Yes. And the reason for that, again, is because we made sure that the fundability was in line. So it just gives people a real world example here of what happens when they don't have that fundability lined up. So again, I summarize again with what we do, and then now I come into it in this, and I actually explain how we do it. We have our business finance suite software that comes with expert advising. So we're combining technology with our actual team that helps you through the process. And then we're improving the fundability. We're building the business credit. We're getting access to all legitimate funding options in one place. Basically, you never need to worry about money again. You've got somebody in your corner that's handling all of this stuff for you and with you, so you then have then you can access the most money for the best terms for your business. Okay, so that is how I am now selling business credit financing. It's how we talk a lot about it. We dive into a lot more about fundability. Probably 30%, 40% of today was all about fundability, because that's what we're now leaning with. We're now going to fundability because nobody's in our space doing fundability. This is something that easily can work very well for somebody to come in and know that it's something that's overwhelming. It's fearful because they know that they're not completely in line. I give real examples of, hey, here's the difference between success and failure and fundability. Here's the difference even if you can get money of doing it the right way. I spend a lot of time there, even more than I do on the business credit financing side. But you can see that I tie it all together as well. So I'm going to open this up for questions. I gave a lot of info here because I want you to be able to use this information in a few different formats. Format A, I want you to do an elevator pitch. What do? We help businesses get capital. How do you do it? We help you improve your fundability, improve the basic fundable foundation that lenders and credit issuers look at to even determine if you should be approved for financing. Then we also help you get financing, all financing in one place, so you don't have to know the right funding program or the right source to get it from. And then we help you build business credit without personal liability, so you can get away from personal guarantees and you can become more fundable. So that's how I really explain it. Now, if I'm doing a real quick elevator pitch, look, we help businesses get capital. We do it by helping you improve your fundability, by building business credit and accessing it without a personal liability. And we help you access all legitimate funding places in one place, or all legitimate funding programs in one place. That's how I sum it up. And the purpose of an elevator pitch is to get people to go, well, tell me a little bit more. Because if I hit on all three of those, there's some level of intrigue or there's not. And if there's no intrigue or interest, well, that's not my customer, right? My customer goes, what do you mean by fundability? Like, I'm concerned. I want to know more about that, right? So that kind of gives the intrigue and the interest to dive more into these topics. And I gave you a bunch of meat on the bone on each one of these three, so you can stand in front of audiences. You can come in and you can do webinars. You can do these kind of things and actually expand on this stuff way more, and then actually be able to come in and really talk to people about why this stuff matters. And that's what a lot of this was, right? This is all about why this matters. So again, that being said, I'm going to wrap up. So to answer your questions, yes, as always, every one of these is recorded and they're in your back office under, I think, weekly coaching webinars. If you go to partner resources and you go to live webinars, you'll access it right there. The most recent webinar is always on your homepage when you log into sweetlogin.com or Sweet Login. And this will be available probably tomorrow in Sweet Login. I'm going to attach this PowerPoint as well, so you have it. Again, as I mentioned, we don't use a lot of these graphics anymore, like cards and money. But again, you could do with it what you want. And you're going to want to make some changes on this for yourself. I am going to remove that fundability graphic from this before I put it in there, because I have strict instructions not to release this fundability graphic. I'm not even really supposed to show it to you today, but I have strict instructions not to release it until it's done. I promise you, if you're just patient, then you'll see why. We're going to give you a much better fundability graphic. You got like version A, we're going to give you like version X that's been through like 100 revisions and improvements, and it's going to be phenomenal. Not only are we going to give you that graphic, but we're also going to have one for business funding and business credit as well that show the overwhelming complexity of business credit and the overwhelming complexity of financing, so people can really get a feel for why they want to work with you in these areas, the difficulty of them trying to tackle these things on their own. So if you have any questions, go ahead and let us know. And your suite, if you log into Suite Login, the top right, you'll see contact us. You can contact your team. You can always reach out to Partner Success at support@creditsuite.com as well. And hopefully this helps you. Hopefully you got a lot of good information out of this. This will be available for playback as soon as tomorrow. So will the PowerPoint be available for download. If you have any questions, just let us know. Support@creditsuite.com. Thanks everybody for tuning in. I'll talk to you next Tuesday here at 3 o'clock Eastern. Have a great day.